Welcome to this Business Tax Roundup for this month. My name is Dean Wootten. Now, the first case we're going to look at is a partnership case concerning the deductibility of legal fees. Now, this case concerned T.R. Rogers and Sons. They're a scrap metal business, and they were run by Simon Rogers and his parents. Now, undercover police officers in a sting operation tried to sell property which they implied to be stolen to the scrap metal business. And it wasn't stolen, it was police property, but they were implying it was stolen. Now, criminal charges were then brought against the partners. Now, Mr. T. Rogers was cleared of charges at the first hearing, but Simon Rogers, he was convicted of attempting to conceal, disguise or convert criminal property. Now, he was subsequently cleared at the Court of Appeal. Now, the partnership deducted the best part of £600,000 worth of legal fees incurred in defending the partners. Now, this was put through the accounts, but HMRC disallowed it. They didn't think it was wholly and exclusively incurred for the trade. So as they were concerned, the defence also prevented a prison sentence and his personal reputation trying to defend that. So it had a dual purpose. And if it's a dual purpose, then you lose the deductibility wholly and exclusive. So the appeal was against the deductibility of the fees. Now, the first tier decided that legal fees were incurred wholly and exclusively for the purposes of the trade. If they were found guilty, particularly the son that went to the Court of Appeal, the partnership would have struggled to continue trading. The lease would have been terminated, the scrap metal dealer's licence would not have been granted, and insurance would not have been obtainable. And because of that, he obviously had to defend the business. In Simon Rogers' case, it was very unlikely that he was going to go to prison. His lawyer said, you've got a very strong case and you've got to defend it. So therefore, it wasn't really defending him personally, it was defending the business. The reason they thought he had a quite strong case was this was only one purchase, and it was one that was pretty much presented to him by the police. Now, his reputation was damaged when the police operation featured in the local news, but that wasn't the thrust of their defence. The only positive impact on his reputation following the success at the Court of Appeal was a byproduct of the case. It wasn't the reason the fees were being incurred. It wasn't to defend his reputation. The reason the fees were being incurred was to defend the business. If they let this go, then the business would have just folded. Now, the next case we'll look at is tax relief on pension contributions. Now, in this particular case, contributions were denied. We don't normally see the deductibility of pension contributions denied in corporates, but this was a tax planning scheme. Now, the company set up an unapproved, unfunded retirement benefit scheme for directors and key employees. It was registered under the disclosure of tax avoidance schemes. Now, the pensions were calculated by reference to the estimated profits for the relevant year, and they were set at 80 or 100% of the estimated profits before tax. Now, there's a couple of companies used the scheme, and they would make provisions for the liability to make future pension payments. And HMRC disallowed the provisions, arguing they weren't incurred wholly exclusively, they were more incurred for tax planning, tax avoidance purposes. Now, the companies appealed, and the appeals were joined. They were schemes provided by the same promoter. Now, First Tier looked at this, and they said, well, the schemes were set up to provide future pensions without an immediate reduction in working capital, so creating a tax deduction which reduced the amount of tax payable by the company. So they were trying to get the best of both worlds, so no reduction in capital, but a tax deduction. Now, the case or the decision was, is this wholly exclusively? That's what they were looking at. Is this wholly exclusively incurred? Now, the tribunal concluded the provision of pensions to directors was at best only an incidental aim. The primary aim was to reduce liabilities to pay tax without incurring any actual expenditure. The engagement letters from the promoter stated the scheme could be viewed as aggressive tax planning, and the size of the pension liability was determined as a percentage of the profits before tax, regardless of the level of those profits and without discussion of or reference to any future pension benefits to the directors. So there wasn't much of a link to reward, performance, etc. It was pretty much set up to reduce tax bills. And because of that, the contributions were not wholly and exclusively incurred, and the appeal was dismissed. So let's now look at some VAT cases, and there are quite important VAT cases this month. And the first one is a German case, but it has relevance in the UK, or potential relevance. A German partnership ran a children's swimming school, and they treated their supplies as exempt education. Now, the German tax authorities stated the partnership was not providing education similar to that provided by a university or school. They concluded it fell outside of Article 132 of the VAT Directive. That is providing education independently of an employer. It's the equivalent of our Schedule 9, Group 6, Item 2. Now, because the authorities thought it fell outside of what is ordinarily taught in school or university, that it was therefore making standard rated supplies. Now, the German Finance Court held that the teaching of basic swimming techniques constituted school education. In the UK, HMRC accepts swimming, basic swimming, as ordinarily taught in school or university. So it didn't seem to be a surprise. But the German authorities appealed to the Federal Finance Court, arguing the services were not exempt and the partnership did not have the status of a teacher giving private tuition. And this is all under the VAT Directive 132. Now, the Federal Finance Court referred the matter to the ECJ. Now, the ECJ found the VAT exemption did not apply, simply because school or university education does not cover swimming tuition. Now, it stated that swimming tuition constitutes specialised tuition provided occasionally, which does not amount in itself to the transfer of knowledge and skills covering a wide and diversified set of subjects or to their furthering and development, which is characteristics of school or university education. Now remember, this is an ECJ decision. Now, what will this mean in the UK? In the UK, we have Schedule 9, Group 6, Item 2. And if you're teaching, or what you think you're teaching, a subject ordinarily taught in school or university, and you teach it as a sole trader or a partner of a partnership, then you have the educational exemption. Now, swimming lessons have for many years been regarded by HMRC as a subject ordinarily taught in school or university. Now, whilst the UK is no longer bound by ECJ decisions, they may have an eye on this. And it'd be interesting to see if they do take note, because this is a much wider area than just swimming lessons. There are many, many clients relying on the education exemption because the subject they teach, horse riding for example, has been regarded as ordinarily taught in schools or university. This case might prompt HMRC to revisit some of those more marginal subjects and have a look. They've already seen some with like Sarok dancing, saying it's too specialised. So Pilates, yoga, etc. are not accepted. But there are many that are accepted where you look at them and you think, really? But they do accept. So HMRC may feel encouraged by this ECJ finding or decision to start looking at this rather generous education exemption in the UK. Now, next slide concerned consultancy services. It was Mandarin Consulting. And now the company supplied career coaching and support services to Chinese students. Now, in the UK, we have this provision whereby if you're providing consultancy to B2C consultancy to non-EU customers, then up to the transition, the Brexit transition, if you're providing to non-EU, it was outside the scope, i.e. the B2C rule didn't stick. Post-Brexit, that rule changed when you're providing B2C consultancy to anybody outside the UK. So it's been widened since the 1st of January 2021. So it's a very relevant case, this one. Before Brexit and post-Brexit, it just got wider post-Brexit because pre-Brexit, it was consultancy, B2C consultancy to non-EU. Post-Brexit, It was B2C consultancy outside the UK, outside the scope of UK VAT with input tax recovery. So everything was fine, and that was accepted that they provided consultancy services. They provided services to the Chinese parents of the children. Effectively what they were doing, they were giving career advice to the children. They were possibly studying over here. They wanted to see which career path they should follow in the UK. And they were giving them all kinds of coaching, career coaching for work in the UK. And they were contracting with and billing the Chinese parents, non-EU, so outside the scope. However, prior to July 16, the contracts weren't actually with the parents. The contracts were with the students. And the students were studying in the UK. So HMRC argued that this stayed B2C because their person they were billing was effectively living in the UK. Now, the parents normally paid the fees, but they were not the contracting party. It was only after July 16 when they changed the contracting party when they were spot on what you needed to be. So this case is all about what went on before July 16 and where their customers were a resident. Now, Mandarin Consulting did not obtain information as to students' permanent addresses in China. They knew they were Chinese over here studying. They did obtain information on where they were living while studying in the UK, but is that enough to say we're billing a non-EU person? Because remember, this is 2016, so it was a non-EU person you had to be back then. Now, in the first tier, decided the company did not establish the usual residence of the customers before the time it made the supply. So the first tier said, look, before you bill, you've got to know where your customers are resident. Now, the upper tribunal said the first tier tribunal had erred in law and they set aside their decision. They said you didn't have to establish residence at the time of the supply. What you had to do was get the evidence gathered before, after, or at the time, and find out from the evidence where the person was resident at the time of the supply. So you could have got the evidence before, at the time of supply, or after the time of supply. That would have been fine, providing it did show that the student was non-EU resident. But unfortunately, the company had failed to provide suitable evidence. Students would often have been usually resident in China, but Mandarin didn't do enough to establish where all, each and every one of the customers was resident. And because they couldn't say that, they didn't get the override, which is now in Schedule 4A, Para 16 of the VAT Act. So therefore you're stuck with the B2C service. And if you're stuck with B2C services, you charge VAT. They were trying to run on an override, and to get the override, you've got to prove where your customer resides. And that's got to be, today, outside the UK. Back then, it was non-EU, but they couldn't prove that. So therefore, they didn't have the proof to invoke the override. So if you're doing consultancy and you're doing B2C consultancy, you've got to be able to prove where your customer belongs to get the shift of place of supply within the VAT Act 1994 as Schedule 7A, Para 16. Well, this case is quite common, and it's looking at the 5% reduced rating, and it was a roofing company, Green Space Limited. Now, they supplied and installed insulated roof panels, and these were fitted onto an existing conservatory roof. A third party manufactured the insulating panels. Now, Green Space Limited installed them by removing the existing glass or polycarbonate panels from the roof structure and then slotting in the new panels into that existing roof structure. Now, the company applied the reduced 5% rate, that is the supply and fit of energy-saving materials, that's Schedule 7A, Group 2. HMRC said, no, that's a roof, and you don't get the reduced rating for roofs. So therefore, standard rated VAT was due in HMRC's mind. Now, first they looked at this and they said, well, the new panels, they're not self-supporting. They can only be used if they've got an existing roof structure slotted in, etc. And it's important that they did slot in to the roof supports, etc. And as far as the first two are concerned, this was a roof, and the appeal was dismissed. Now, the company took this to the upper tribunal, as you'd expect, because if they're charging customers 5%, and HMRC come along and say, actually, it's 20%, and how long have you been doing that? Oh, yeah, let's go back 4 years and adjust. So this went up to the upper tribunal. Now, the upper tribunal looked at this, and they said, well, we're inclined to go with what the first tier say. And because as far as they were concerned, the upper tribunal, once fitted, the panels covered the entire conservatory roof and formed the roof. So therefore, this was a roof, and the 5% rate did not apply. Yet, had the panels been installed on top of the existing roof, or maybe underneath the existing roof, then you would have had more chance of getting it as insulation. The fact is, these panels replaced the existing panels, and therefore they became the roof. And you don't get 5% when you go beyond what the reduced rating for is, which is for insulation. This case was a bit of a try-on by the looks of it. There was an individual that ran a pub from rented premises in London. The lease was in his wife's name. The landlord had opted the property and had raised invoices on that basis. Now, between 15 and 17, over 11 quarterly returns, the individual sought to reclaim £1,300 of VAT per quarter, with one quarter being for the best part of £5,000. HMRC denied the claim, stating there was no tax to supply from landlord to the individual. The lease was in his wife's name, and there were no VAT invoices to support the claims or evidence they'd actually paid the rent. The first tier confirmed that there's no evidence to support these deductions, so without evidence you can't have deduction. There's no property lease produced in either his sole name or jointly with his wife. There's no partnership agreement to evidence the partnership being there at all. There was no VAT rental invoices addressed to the individual, and there was no bank statements showing payment of any rent. So the appeal was dismissed. Remember, when they take these cases, they take the case for the individual who's claiming. So they're not looking at the wife's affairs, they're looking at his. And on his affairs, he was claiming input tax on something that he couldn't prove he paid or even was addressed to him. That's the fundamentals for input tax. The invoice must be addressed to you, and you must obviously incur the cost. And next slide is an important case. It's Gray and Farrer, and they're an upmarket dating agency, and they charge fees ranging from £15,000 to £140,000, so very upmarket. And the services provided included initial interviewing, vetting processes, creation of a client's requirement brief, the matching process itself, follow-up phone calls to the client, feedback, etc. And all but the last stage of the services were carried out by the managing partner, so quite a bespoke service as you'd expect for that type of fee. Now, the LLP treated the supplies to non-EU customers, this was pre-Brexit, as outside the scope. They were relying on the Schedule 7A, Para 16 provision, and that is when you provide consultancy services to non-EU customers. So similar override to the Mandarin consulting, but the point in this one was HMRC didn't believe that this was consulting services. Consultancy services has been decided to be provision of expert advice, amongst other things. And HMRC said, well, you've gone beyond that. If you go beyond that, you don't get the override within Schedule 7A, Para 16. What you get left with is your basic B2C. So therefore you charge VAT. Now, the client appealed to the first tier. Now, HMRC, they were very much of the opinion these are not consultancy services. The first tier said, well, we've got a single supply of services here, and the material elements of the supply went beyond the provision of expert advice. And as they went beyond the provision of expert advice, the supply was not services of a consultant. So in the first tier's mind, B2C stuck, and UK VAT was chargeable. And the reason they thought that was that post-introduction, Liaison calls were important and material. They weren't just incidental to other parts of the supply. So in their mind, it went beyond the provision of information and expert advice. So it couldn't fall within Article 59C of the VAT Directive, or indeed Schedule 7A, Para 16 of the UK legislation. So the appeal was dismissed, and in the first tier's mind, VAT was chargeable. Now the LLP appealed to the upper tribunal. Now the LLP argued that the first tier had erred in law. They had failed to properly characterise the partnership supplies, and they weren't giving effect to a predominant element of this service. As far as the client was concerned, LLP was concerned, their fundamental element was consultancy. Now the upper tribunal confirmed that the first tier had erred in law. Now, the post-introduction liaison service, which arguably did go beyond the consultancy, didn't necessarily mean that the supplier fell outside of the consultancy definition. It was possible to fall within that definition despite an element of the service going beyond that. And now we've got to look at what the predominant element is. Now, a typical customer received expert advice and information relating to potential matches. The post-introduction liaison services were not enough to change the main character of that service. In the upper tribunal's eyes, it was consultancy. Introduction to a possible match through expert advice and related information were key. Consequently, the matchmaking services supplied to non-EU clients fell within the definition of consultancy, and as such, when they provided to non-EU clients, were outside the scope of UK VAT. Obviously, post-Brexit, they just need to provide to non-UK clients. This was a pre-Brexit case. Well, that concludes the business tax roundup for this month. My name's Dean Wootten. Thank you for listening.